Do you remember only one technical thing from this entire video? Make it this, the expense ratio. This is the annual fee an ETF provider charges to manage the fund, and it's shown as a percentage of your investment. Here's how to think about it. If you invest $10,000 into an ETF with a 0.10% expense ratio, you're paying just $10 a year. But if that same ETF had a 1% expense ratio, you'd be paying $100 a year. Now, that might not sound like a huge deal, but this is where compounding, the most powerful force in finance, can silently work against you. Over time, these tiny-looking fees can devour a shocking amount of your money. Let's run the numbers. Imagine you invest $10,000 and it grows at an average of 8% per year for 20 years. In a fund with a low 0.25% expense ratio, you'd end up with about $30,451. But in a fund with a higher 1% expense ratio, you'd only have about $21,610. That's your money, just gone, eaten up by a fee that looked harmless on paper. This is why for your first ETF, the expense ratio is non-negotiable. So here's the rule. Look for broad market ETFs with expense ratios below 0.20%. And honestly, you should be aiming for funds under 0.10%. Some of the best and most popular ETFs have fees as low as 0.03%. For every $10,000 you invest in a fund like that, you're paying just $3 a year. It's amazing. Seriously, there is almost zero reason for a beginner to even look at an ETF with an expense ratio over 0.5%. Think about it. Cutting costs is the only free lunch in investing. It boosts your returns without adding a single ounce of risk. Getting this right is the key to starting your journey on the right foot.